Welcome back. Now, in the third quarter, South Africa's GDP came in below expectations, contracting by 0.3%, reversing the growth of the same margin experienced in the second quarter. This was largely driven by a near 29% decline in the agriculture, forestry and fishing industry during the period. Keabetswe Mojapelo, macroeconomist at RMB, joins us with a closer analysis of the print. Keabetswe, thanks so much for your time today. Now, the first quarter under the GNU, and here we are. The numbers don't really look great. Growth, as I mentioned, easing there, down 0.3%. Expectations was for growth of 0.5%, as sentiment, of course, generally improved following the national election and as we've had another quarter of constant energy supply. What have you made of the print? Just your general reactions right at the top.
Yeah, no, thank you so much. I think we're reading too much into the numbers. They're really underscoring what we already know about the economy. Most importantly, on the logistics side and demand. And on the logistics side, if you look carefully, it's those sectors that are reliant on logistics that really drag growth the most. Of course, you do see from an energy perspective, mining, manufacturing, they could have been better if they were aided by better logistics, right? But if you look at the transport sector, it detracted. And then more importantly, it then looks into the external sector. Look at the export side. Exports contracted quite considerably. Of course, it's not just a story of supply. You do have slowing demand from our trading partners. And a stronger rand really does not bode well for exports. And that also came into play. But if you look at it holistically, logistics are playing a big role. We are seeing the importance of energy. And also from a demand side, from households were really dragging growth to some extent. Of course, they did pose a positive growth number, but if you look at what were they buying, recreation was a big spender, and that's gambling. That's telling you that households are spending on these frivolous activities to try and really build up their income and spend on other things, basically try to add to their discretionary income, underlying the fact that high interest rates are still really holding them back. Even if you do have a cutting cycle, basically you just untighten the belt. You're not necessarily going to let people go back to the mall and spend more, and you see it in the numbers.
Let's zoom in on that household resilience index. You did say there that, yes, it's improved, but we're seeing that consumers are spending on frivolous activities like gambling, just underscoring that, the consumer is still under pressure, right? So we have that taking place, the consumer under pressure. We are seeing slowing inflation in the meantime. We are seeing rate cuts, as you've mentioned, but it doesn't seem to be coming through as yet. With that being said, do you think this opens the door for potential for bigger rate cuts from the SARB moving forward?
Well, I mean, we should take cognizance of the fact that the SARB is an inflation targeting central bank, and they've always bemoaned the fact that growth is a structural issue, i.e. this logistical constraints that we're seeing right now holding back growth. But you can expect the central bank to play its role, in stabilizing this low end of the business cycle that we're experiencing at the moment. The fact that you have households who are relying on gambling to try and increase their income tells you that from an income perspective, there isn't really much to work with. And the central bank in cutting interest rates, at the moment, you must always think about interest rate cuts from a real perspective. It's real rates that matter for the real economy. So if you have a real rate that we currently have, about 4.95, depending on how it's calculated, still quite constraining. And until the bank cuts substantially, you're still going to see this drag. Essentially, real rates being above what they would call an R-star still really means that the economy still, monetary policy is still constraining the economy in some way. So you can cut, but you're basically just untightening the belt. You're not necessarily, letting the floodgates open on credit demand from households.
And I guess that, brings to light the importance of those structural reforms. Yes, we are seeing improved sentiment. Yes, we are seeing improved business and consumer morale, but it then has to translate into actual changes in the economy. Keabetswe, let's talk about the agri-sector for a bit. Negative factor in this print, posting declines of over 28% on the back of poor weather conditions. How concerned are you about the downturn there, or is it just, a blip and we could possibly see recovery coming through on that end, possibly in the fourth or the first quarter of next year?
I mean, with the agricultural sector, it's a precarious one because you'd rather look at the annual number. So it's quite volatile. It's subject to large revisions, but you're still not really going to see a big decline even after revisions. The annual number itself is looking contractionary. And essentially, if you look at where agriculture is coming from, it's been mired by, several shocks from a climate perspective, the El Nino drought that's affecting maize, soya beans, and as well as the fruit segment. And also, I think from a meat perspective, they haven't recovered much from the previous foot and mouth disease, as well as the chicken, or rather that flu disease from the poultry perspective. So what you are seeing is those effects, but you will see it from next year, maybe with better rain, the sector will likely recover.
When we started the conversation, you did say that perhaps we're reading a bit too much into these numbers. With that being said, with the GDP print for quarter three contracting 0.3%, how much of a worrying factor is it for RMB? Would it be to a point where, we start adjusting figures for annual GDP?
Yeah, I mean, it missed our estimate. We had a 0.3 penned in. So it will basically, lead to a bit of a downward revision of what we thought would be a 1% growth for this year, likely revised down to around 0.8. But going into the fourth quarter, remember, we have this two-pot system that's basically about to exceed expectations in terms of withdrawals. And you do also have this relief coming in terms of interest rates. You mentioned the confidence that's coming back into the economy. You look at the investment numbers, their segments, their construction has been growing in the last 2 quarters, given the fact that it had declined for about 5 quarters prior. So you're seeing this tailwinds that are building up. And so going into the fourth quarter and into next year, there's quite a lot that's supportive of much more buoyant growth. And you should see that come through as well.
Keabetswe, thanks so much for joining us and taking us through the third quarter GDP print. That was Keabetswe Mojapelo, macroeconomist at RMB.